Growth stocks have been the key driving force fueling the recent global upswing in global stock markets. These stocks typically operate in industries like technology or innovative healthcare firms, where there is likely to be significant potential to expand the business. As growth stocks typically boast revenue and earnings that zoom past their peers, they offer robust return potential as part of a long-term portfolio. Exploring the potential of growth-oriented exchange-traded funds, or ETFs, can offer a balanced approach for many investors seeking to navigate the dynamic and volatile landscape of the stock market. First, let's give you the name of the fund we are discussing in details today. It is the ETF Prime Cybersecurity ETF, where the ticker is HACK. But before we begin our discussion, please remember that this video is for informational and entertainment purposes only. Please consult a financial advisor in your jurisdiction before investing your own money. Also, please like and subscribe. Thank you. How can investors potentially hack into portfolio growth with the ETF Prime Cybersecurity ETF? The HACK ETF currently hovers around $60 at 52-week highs. Over the past year, it has returned about 38%. Before we introduce the fund further, let's remind readers the expense ratio stands at 0.6% per year. Businesses increasingly recognize the growing need to defend against cybercrime, fueling the boom in the cybersecurity market. Businesses understand that a cyber attack is no longer if, but when. As the demand for cybersecurity measures continues to rise, investments in ETFs like HACK could benefit from the potential increase in spending to counter cyber threats. Funds like the ETF Prime Cybersecurity ETF, or HACK, are valuable tools that tap into the booming cybersecurity sector. HACK focuses on global companies providing cybersecurity solutions, investing in a diverse mix of firms offering hardware, software, consulting, and services to combat cyber threats. The global cybersecurity market, which was valued at around $156 billion in 2020, is projected to reach $352 billion by 2026, representing an annual growth rate of over 14%. This growth is driven by increased digitalization, which has also led to a rise in cyber threats and vulnerabilities. Launched in November 2014, HACK tracks the Prime Cyber Defense Index and comprises 48 holdings across various subsectors. The fund has seen its assets under management reach $1.6 billion since its inception. Leading the pack are U.S. companies, at around 86%, followed by the UK, 6%, Israel, 5%, Japan, 1%, and Canada, 1%. In terms of subsectors, systems software leads the pack at about 41%, followed by internet services and infrastructure, 18%, research and consulting services, 15%, communications equipment, 12%, and application software, 7%. Notably, the top 10 holdings make up almost 45% of the fund, showcasing its concentration in established players. Cybersecurity and networking solutions provider Fortinet cloud security company, Zscaler cloud-based identity solution provider OKTA. The content delivery network, Cloudflare, and cybersecurity company CrowdStrike Holdings lead the names in the roster. With the increasing awareness of cybersecurity risks, the fund has experienced significant growth, gaining over 38% over the past year, as we have already noted. The fund's recent performance and the projected growth of the cybersecurity market make it an option worth considering for investors looking to capitalize on the cybersecurity gold rush. If you are considering investing in the HACK ETF, a potential dip towards $57 could likely offer a better entry point into the fund for growth-oriented investors. As we come to the end of our discussion, we would like to remind you that the information shared in this video are for educational purposes only. They should not be considered financial advice. Keep in mind, do your research, diversify your portfolio, and always manage your risk. And finally, leave a comment below. What are your thoughts on growth ETFs? Also, please remember to like and subscribe.